I put this out on our YouTube channel last week. There is a very big divergence in the market right now. And unfortunately, it's been there for quite some time. And what I mean by that is when people talk about the market is going up. What they're generally referring to is the S&P 500 or the Dow Jones. That's not the market. The S&P 500 is 500, it's technically 503 stocks, but it's cap weighted. So the top 10 stocks in that index account for 40% of the return. So it's happened many, many times where the S&P 500 posts a profit for the day, but 490 stocks out of the 500 are down. Well, how is that possible? So the market is actually very, very thin, and that is one of the very big risks that we are seeing in the market right now is the average stock has really gone nowhere for a couple of years. So yeah, the market has gone up, but that's the Mag 7. That's the top 10 stocks that are just they're thriving. And so the average stock has not been doing well in this environment, and that's not a good sign. Now, you also know that the Federal Reserve has cut interest rates a couple times. Now there's talk that they might not actually cut rates again next month, like most of us were thinking they would. Well, that means they're starting to ease, and so there is an argument that the average stock and the average company has been in a mini, what I'll call an undeclared recession for a couple of years, underneath the surface. Now you could argue easily that the tariffs has not helped that company, right? Well, if we're starting to see some of this easing from the Federal Reserve, there's an argument that perhaps we are finally going to get a tide that's going to raise all the boats. But right now, we don't have that. We only have a very thin market. More than half of the stock market is negative. By that, I mean more than half of the stock market is below their 200-day moving average, which indicates a downtrend. That's not healthy.